Hey, what's up everybody? It's your mortgage expert, Brian McCauley here. So you're looking to buy a house or maybe even refinance in Dallas, Texas, but you're worried about affordability and these interest rates just aren't coming down fast enough. Stick around. In this video, I'm gonna teach you how to get cheaper payments right now without even having to worry about lowering rates. So listen, the DFW housing market is still strong. We are seeing a lot of buyers out there, a lot of activity. Interest rates have come down. They're hanging around probably the low sixes. You can maybe get them in the high fives with a little bit of discount points. And so that is helping with affordability, but it's not helping with affordability enough. So what is the option? Well, we've gone through some videos on getting concessions on closing costs, on taking stuff off the price of the house, all these things and above. But today's video, I'm gonna teach you a secret on 2 mortgage terms that we have that will help you with affordability and lower the payments until those interest rates get to where we want them to be. First and foremost, there's a lot of talk about a 50-year mortgage being proposed out there. I'm going to talk about that at the very end of this video, but what I want to talk about right now, which is currently in effect, and we do it for a lot of clients, is a 40-year mortgage. Some people think it's crazy to take a 40-year mortgage or a 50-year mortgage. Here's my approach on it, right? From a 30-year mortgage standpoint, people always talk about, well, you're going to pay so much more interest over the life of the loan. Folks, I will promise you in my 20 years, I have never, ever met one client that has taken a 30-year mortgage and made 360 consecutive payments all the way until the time that the mortgage is paid off. Most people keep their mortgage for somewhere 3 years minimum, but average probably 5 to 10. So the interest over the life of the loan is irrelevant. What I want everybody to realize about a 30-year mortgage, more specifically for this program, a 40-year mortgage, is it will cut the payments down by a couple $100 a month. What that does is it gives the potential consumer and home buyer and potential person that wants to refinance a couple $100 more in affordability and debt relief. And this is a good idea because as a homeowner, what you want to focus on, people focus on affordability, people focus on monthly payments. That is primary focus number one. A 40-year mortgage will allow you a couple $100 extra a month. If you want to throw some icing on the cake, we have a 40-year mortgage with an interest-only payment. Most mortgage payments are principal and interest, but in the first couple of years of the loan, you pay a majority of interest only. And so obviously, when there's very little principal paid, sometimes people will take an interest only as well to shrink down the amount that they're paying to the mortgage company. But keeping it basic, a 40-year mortgage will probably increase the savings and probably improve the payment by maybe $250 on about a $400,000 loan. So why does this matter for somebody that's looking to buy? Number one, you can get the house that you want with a little bit cheaper payments, and that gives people a lot of relief and safety when it comes to a debt-to-income perspective. Number two, I don't suggest this, but in the event that you had a 30-year mortgage and you couldn't quite qualify for the house that you wanted because the debt to income was a little bit too high, taking a 40-year mortgage would allow you about an extra 4 to 5% buying power. So let's say there's a $400,000 house and you just can't afford it on a 30-year, you could probably afford it on a 40-year and qualify. So it gives you more buying power and it also can give you payment relief. Now, when people talk about, well, you're gonna pay so much more over the life of the loan. Again, I have been doing this for 20 years. I've owned probably 4 or 5 houses. The only house that I've kept the longest is my current primary home. I've been in it 10 years. It's gone up in value. It's doubled. I bought my house back in 2016 for about, I think it was $900,000. It's probably worth 1.9. So what I want you guys to focus on is people think taking a 40-year mortgage is stupid, but what people need to focus on, that 5 to 10-year range, is really the appreciation of the property. This is where real estate is made. Texas specifically, homes average probably 4% a year in appreciation. So if you buy a $500,000 home, it appreciates at 4% a year. That's 20 grand a year. You keep it for 5 years, you're going to make $100,000 based just on the appreciation and the equity. So yes, you may pay a little bit more in interest over 5 to 10 years, but obviously you're going to have cheaper payments. And so home buyers need to recognize that the 40-year mortgage and the 50-year that I'm going to talk about at the end does give you payment relief. When people talk about that's a bad idea, it's going to cost you so much money over the life of the loan, I honestly challenge anybody to find or drop a comment below of anyone that they've ever met, known, friends, family, clients, customers, whatever, that has bought a house, got a 30-year mortgage, and literally paid that mortgage forever, minimum payments, 360 payments all the way to the life of the loan. I don't think it exists. I've never seen it in 20 years, but if you find one, tell me. Most people sell the house, most people refinance, most people pay it off sooner, but they usually keep it 5 to 10 years. So the secret and the focus on getting a 40-year mortgage is to give you, the consumer, a little bit more payment relief so your overhead is not as tight and you feel better about the affordability. You still want to bank on the fact that you're going to get about an average of 4% appreciation a year. You're paying in the mortgage a little bit, and you get tax deductions on the mortgage interest, which means you get money back on your money. Now, full disclosure, I'm not an accountant. There are some standard itemized deductions that you take. If you take those, I don't believe you can take the mortgage interest, but if the mortgage interest exceeds the standard deductions, most people take the mortgage interest. All that means in a fancy way is it is a tax incentive to deduct the mortgage interest on your primary home, and it can bring your taxable income down, which can save you money as far as what you owe Uncle Sam. So again, I think people think, oh, 40-year mortgage, it's going to be cheaper per month, but I'm going to pay so much money over the life of the loan. You're going to keep it for a shorter period of time, probably 5 to 10 years. The house is going to go up in value, probably 4% a year. You keep it for 5 years. We use the $500,000 example. You make $100,000. You pay down the principal a tad. You get tax deductions on the mortgage interest, which means you get money back on your money. And then at that end of 5 or 6 years, you sell the home. Out of the $100,000, maybe you pay a little closing costs, maybe you pay a little commission. Let's say you walk away with $75,000. That $75,000 is also tax-free. So on a primary home, on the proceeds that you make on the property, if you are a single person, you do not get taxed up to $250,000. If you are married, you don't get taxed up to $500,000. So you're making money on the property, it's appreciating, you're paying down the principal a little bit, but it's better than nothing, because obviously if you're renting, that's 100% going straight to the landlord versus you. And then it puts yourself in a position to really set yourself up for success for good ROI. So these are the things that I want people to focus on is, yes, we have a 40-year mortgage. Yes, we have a 40-year interest only. It's not for everybody, but it is for a lot of folks that are trying to get some payment relief until the interest rates come down. So last but not least, there is a potential proposal out there from this administration to take that note from the current 30-year to a 50-year. It's the same concept. Is it the end-all be-all solution? No. Is it better than people sitting around and waiting for 2 or 3 years for rates to come down to get relief or continue to rent? Yes, because the focus again on buying a house is the appreciation over a period of time, paying down the note, getting tax deductions. And also, I want everybody to understand there's 3 types of debt, right? Well, there's good debt and bad debt, but there's 3 main types of debt. And I want everybody to take this away as the last thing on this video when it comes to how you think about leveraging debt to make yourself money. So the 3 main types of debt that are out there are credit card debt. Number 1, it's the worst debt. Why? It's revolving. It's not collateralized against anything, and it has really high interest rates, and it can get people in trouble. I like people to keep their credit card payments really down and don't get themselves in trouble, but credit card debt is the worst debt. Debt number 2 would be like vehicle auto debts. That's kind of in the middle. Now, the reason that's in the middle is because it is debt that is collateralized by an asset. That asset is a vehicle like a car, which means if something goes wrong, at least you can trade in the car and get your money back, get a refund, or at least if you spend the money on paying off the car, at the end of the day, once the car is paid off, you have an asset. And so you'll have some equity, you'll have something of value that you could potentially sell or trade in the future and get some money on it. The downside with cars is that cars are a depreciating asset, meaning they go down in value and you don't get any tax deductions on the car payments. Now, number 3 is mortgage debt. In my opinion, it's the best debt. Why? It is also debt that is collateralized by an asset, the house, except the difference from a car and a house is an appreciating asset. It goes up in value. And then you get tax deductions on the mortgage interest, which means you get money back on your money. So you using debt, it's collateralized against an asset that's going up in value, so you're making money, and then as you're making payments on the house, you get tax deductions on some of the interest, where a car goes down in value, so you're depreciating, the asset is depreciating, so you're losing money, and you don't get tax deductions on the payment. So these are things that I want people to focus on when they think about buying a house. Yes, we want to set you up with a good mortgage that you're comfortable with, that the payment's okay, that you don't put yourself in a bad position of too much risk. But whether it's a 30-year mortgage, our 40-year mortgage, or maybe the potential 50-year mortgage in the future, Payment relief is good. Don't pay attention to the interest paid over the life of the loan because nobody keeps a mortgage for that long. Focus on the stuff that I talked about in this video. This is the way to think about buying a house. And I think for some folks, a 40 or a 50-year mortgage right now is the way to go to give yourself relief, to get into a property, to start the homeownership journey, start making money and paying attention to the future versus continuing to rent, staying on the sidelines, wasting money on rent, and paying your landlord's mortgage. It's time to start paying your own, and you might want to consider that 40 or 50-year home loan. So listen, if you found this video useful, do me a favor, like, comment, subscribe, share it with any of your clients, any of your friends. And if you want to talk more about this 40-year mortgage home buying journey, pre-approval process, do us a favor, call us, email us, text us. We are always here for you. Until next time, stay tuned.